Welcome to the Sailing in Uncharted Waters SFG live chat. I'm Dennis Stearns. I am joined by SFG's co-chief investment officer and global strategist PJ Williams, and John Thomas is supposed to be joining us, but has been having some technical difficulties, so he may join us, or it may just be PJ and I. So we have a lot to report on. It has been busy on all fronts, from the very first, where we started looking at the effects of the virus and how that impacted certain parts of the economy more than other parts of the economy, to the potential for economic recovery, how fast, U-shape, V-shape, W-shape, square root shape, and what is really borne out is what we talked about several chats ago, and that is that it depends on what industry you're in. And there are some industries that are recovering much faster than maybe anticipated. There are others that not so much. And there's a few. We don't invest in bars at SFG, but we have a couple clients who are partners in bars, and that has become problematic as many states have rolled back bars and they're reopening. So just a lot of interesting intrigue going on today. So let's kick it off. PJ, walk us through this first one.
And so what we're looking at in this slide is comparison between kind of a 7-day moving average of new positive cases of COVID-19 and the number of deaths across the US. And what you can see is they tracked pretty closely early on with a lag in the deaths. Again, it took a couple weeks from testing to be positive. And again, we know there wasn't as much testing going on back in March and April, to when hospitalizations picked up, to then ultimately and unfortunately the death toll rising in the U.S. What we saw is back, it's a lot of the shutdown in late March and April, when many states across the country were shutting down, that we saw kind of a rollover, and the daily positive tests started to decline. We also saw deaths decline as well. We know that when May came about, reopenings across the country started to happen. Some states opened faster than others, and you can see that combined with, we know that there's been a significant increase in the number of tests being administered in the U.S. Not surprised to see the spike back up in positive COVID cases. And at the same time, we've seen that as they spiked during June, that the death toll in terms of number of daily deaths has continued to decline. But what we need to look at is the fact that this data on this chart is through June 29th. And so that was kind of a period where, okay, we've seen number of positive cases spike. We would expect the lag, if we are going to continue to see a similar trend as we saw back in March and April, that we begin to see this trough form on both hospitalizations and deaths. And, I think the hope was for, people across the country, regardless of who you are, and obviously the market's hope was that maybe what we saw back in March and April was focused on a specific demographic. And especially, we know that a lot of the cases that turned into hospitalizations and unfortunately deaths were clustered in nursing homes, that maybe that this time around, with the better measures that nursing homes and other hospitals are taking to kind of prevent the spread of the disease, that we would not see a trough form here and a spike. Unfortunately, when we turn to the next slide, what we've seen in hospitalizations, at least, is that in late June, around the third week of June, they started to pick back up. You've heard about certain states, whether that be Arizona, Texas, Florida, seeing significant increases in cases, certain hospitals having their ICUs full again with COVID patients, unfortunately. And so the next thing that we'll be looking at and following is, does this increased hospitalization again lead to an increase in, unfortunately, deaths? The latest data looking at July 7th, July 8th, we've seen a slight uptick in the number of daily deaths, but we'll need another week or two to see if that trend continues. And so that, combined with what actions do the states take in terms of reclosing, they started with bars, as Dennis mentioned, we could see more, will kind of potentially drive where we go from here in the near term. But what we also have to acknowledge from the market's perspective is that the uptick will be definitely a concern, and it's definitely scary again with what happened back in March and April. But you're seeing that kind of juxtaposed with the hope for a vaccine, or what's probably going to be sooner, a drug that limits or prevents, let's use the word reduces the amount of deaths from the people that get the most sick. What we've seen is this morning, even, futures were slightly negative, and then Gilead came out and said their remdesivir drug is showing signs that it has reduced the number of deaths from people that are significantly sick. So again, it's not going to prevent death, but potentially, hopefully, help people that get that sick, to keep from dying. In the same release, they also acknowledged there needs to be a lot more testing to confirm what they just stated. But that news was received very warmly by the markets, and futures turned up from there. We'll see where they go the rest of the day. But again, this is something that we will continue to be looking at very closely over the coming weeks.
Yeah, so we continue to talk to a lot of our infectious disease folks in our network, epidemiologists, emergency room physicians, and other people in healthcare. And the news, again, goes back to something that we reported on over a month ago in some of our chats about how the good news is the healthcare system is doing some real-time pivoting to be able to treat people better. And there's some just amazing stuff going on to help in that reducing the death rate or the serious illness rate. And so I think that is creating a feeling, maybe we're not down to flu numbers yet, but creating at least somewhat the feeling that maybe this is a little bit more manageable in terms of the potential for death. We were on a video yesterday with somebody who said, when I talk to small business owners, do they choose to lower profits or to die when they're out of business permanently? And so I think at least a few people are thinking, well, maybe that worst case scenario, it's not off the table, but it's mitigated some. And so again, hopeful that will continue. And then I think if that does continue, right back to the point of what's the stock market going to think about that? Stock market is going to continue to think out a year or more ahead. So again, it gets back to the thing that we've talked about a lot. Short-term emotion, the stock market's a voting machine and can panic. But longer term, it's a weighing machine. And when it weighs out the earnings from companies 2 years from now, 5 years from now, 10 years from now, and then discounts them back to today, when it's in that weighing machine mode, it doesn't act as freaky. But for those of you who read Freakonomics, which by the way, we've had several clients who have revisited that book. It is a really interesting book. If we do get some surprises in this on the negative side, on the COVID, then that's where we could go back to some voting machine emotion shorter term. So next slide.
And so, this kind of ties into what we're just talking about with what the kind of the market's looking for. You're kind of seeing, okay, retail traffic in terms of people, going out, going to stores, not surprising, fell off a cliff in March with the early COVID warnings that turned into obviously states closing down and stores across the country shutting down. And so we've seen not a V-shaped here, but you've seen the V-shaped in the markets. And it's based on what you're seeing here, a trend that things are trending back. People, as things reopen, people were willing to go out, and you've seen a bounce back, but you still see that we're well below the levels that we were in February. And what's concerning, and it kind of goes back to maybe what you saw in the previous slide, of hospitalizations picking up, number of positive cases picking up as we've reopened, that people may be scared now, even if the stores are open. Do people want to, especially when you have access to Amazon, are you really going to go out if you don't absolutely have to? Certain demographics are probably more in that camp, and so you're seeing it roll over. And so as we talked about, really the last two slides, really the next 2 to 4 weeks are going to be very interesting to see what happens with first the COVID side of this, and then with the economic side, and then another part of this that we haven't even talked about yet, but we're going to address, is what does the fiscal or monetary response look like? We know that that was a big part of what happened with the economy being able to, I'd say, continue along, and we'll look at what we've seen in areas that things have continued to go along, rent payments in certain parts of the market, along with the stock market bouncing back so strongly. A lot of that was based on the stimulus that was provided both by the Fed and by Congress. Will there be another round of that? There's lots of talks, and what would it look like? That's, again, the next 2 to 4 weeks, we will have more clarity on what that next round is going to look like.
And there's your rent collections.
And so I just referenced this. We're looking at 2019, looking at the same 3-month period, looking at April, May, and June. Again, this is a survey. There's definitely pockets, and there's definitely certain areas of multifamily that are not experiencing rent collections that look this strong. That's definitely an acknowledgement. But in terms of the survey that BCA is looking here from the National Multifamily Housing Council, they're seeing very similar collections to what they saw last year. And you're looking at June collections that through the 27th of the month of 2019, 94.7% from this survey. 2020, 27th of the month, collections at 94.2, right in line. And again, it goes back to a lot of this is being supported by the stimulus that provided the $1,200 checks, the increase in unemployment benefits. That's allowed Americans that were hit with the unemployment to continue to make certain payments, and rent collections been one of them. But again, there is a cliff coming at some point, and the question is, does Congress and the Fed, do they push out that cliff for when these extra unemployment benefits and other parts of stimulus, when do they cease? And then where's the economy at that point? Where's the virus at that point? And have we gotten back to a point where you don't experience that cliff? And that's going to be a big key here.
Yeah, and one of the things that helps us sleep a little better is that we have been focused more on high grade, high quality apartments, for example, in portfolios. And the people that tend to be tenants of those higher quality apartments tend to be the ones less affected by COVID. And it's the lower income folks, and we've showed slides in previous live chats about the dramatic difference between people who are in retail, people who are in the leisure industry, which generally make a lot lower hourly wage than professionals or others who can telecommute in many cases. And so I think, again, to PJ's point, as we go forward, we're likely, if we parse these out between A-rated properties and C-rated properties, we're probably going to start to see a divergence there. There's been some scuttlebutt that the next wave of federal unemployment insurance, because of the fact that so many small businesses have complained that the $600 a week federal subsidy combined with state is actually more than people were making in the small business to begin with. They're having trouble getting people back to the business. And so there's been some scuttlebutt that maybe they'll cut that from $600 to $300 a month. Again, that probably won't impact as many of the things that we're involved with, but it certainly will impact certain parts of the economy.
And we've alluded to this early in this chat. We've talked about in the past, looking at the correlation between the Fed's balance sheet here and the stock market. And you can see that the Fed went into action in middle March when there was liquidity issues in the bond market. Obviously, the equity markets were struggling. The economy was struggling. They went into action, providing a lot of monetary stimulus in different ways, dropping rates to zero, starting new loan programs, starting to purchase bond ETFs. A lot going on with what the Fed is doing to provide stimulus. And you can see as a result of that, their balance sheet expanded sharply from just over $4 trillion to where we're at today, around $7 trillion. And with that, the markets come back. But what you can see is that really the last month, as that initial stimulus is kind of plateaued, their balance sheet is plateaued. the market traded sideways. We hit a high around June 8th, and we've been pretty much sideways since then with a few bumps in the road, definitely. And so the question is, if you see that next round of stimulus, what does that do to the Fed's balance sheet? It's a big piece of that. And do you see the correlation continue? We definitely do not expect for this to roll over and for us to see a decline in the balance sheet. But the question is, if you see a rise like you've seen here, will the market be correlated with that? I wouldn't expect it to rise at the same magnitude. That would put us well past all-time highs, and we know that. So that's not an expectation. But would that be, again, supportive of the market in that situation?
Yep, and there's an old adage that we've talked about a lot over the years: don't fight the Fed. People who have fought the Fed, meaning going against the grain of what the Federal Reserve is doing, generally have lost large amounts of money. So this is definitely something to keep an eye on. So this is from the American Association of Individual Investors, their sentiment survey. And what you see with the orange line, that's the percent that are bearish, meaning they think that the stock market may decline before it goes up. And the blue is the percent bullish. And you will note in just the last few weeks, there's been a significant number that are more bearish and a significant less number that are bullish. Now, in the past, there's been a question of, is this a contrarian indicator? So some of these sentiment indexes have actually been contrarian indicators that people are, again, more emotionally voting, and emotions are a really bad thing to try to invest your money. The AAI is a little different animal, and so many of you know we have been a supporter of the AAI as a national consumer education entity. We have given a number of talks for them. Some of our folks have been officers in their chapters. We believe a lot in them, and they have a generally better educated investor. Now, that doesn't mean that they are always right or that they don't occasionally get subject to short-term emotion. So this, I wouldn't use it as a complete contrarian indicator. I'd probably say, it's something to pay attention to. And what's interesting in talking to some of our clients recently who are members of the AAII, they have said that the reason they're a little more bearish has nothing to do with COVID. It has to do with a whole bunch of other factors, which we're going to talk about a little bit as we go here.
On this slide, we're going to look at S&P valuation measures. I would like to we think JT is joined by phone. JT, are you there?
Yes, PJ, I have been able to come in. Sorry for the technical difficulties and not be able to join you by video. But so valuations obviously are a starting point in any of our assessment of investments. We want to be able to see that we're getting a return for the risk that we're taking on by the investments. Here we're looking at the forward price to earnings ratio of the S&P 500. And I think it's important to remember how much those earnings are borne by some of the technology and higher tech type companies recently. So a lot of the consumer discretionary segment, those that have been most hit by the shutdowns, the lockdowns, the unemployment, have a fairly small contribution to the earnings of the S&P 500 writ large. But what you've seen is obviously a huge increase in the price to earnings ratio as stock prices have recovered, again, spurred by the technology sector particularly, while earnings are being adjusted lower steadily. So we're about to enter the earnings season. We're going to be seeing a lot more reports from these companies over coming weeks. The general expectation is that may result in walking back the expected earnings or profits over the next 12 months, which could push this sort of measure even higher. So whether you're looking at the forward PE or any of the other measures in the table at the top, the basic takeaway is that unfortunately it's hard to see a lot of historic value in stocks. So this is another cause for us to be a bit more wary, a bit more suspect of the bounce back, and positioned accordingly within most portfolios.
Yeah. So, again, one of the slides that we showed about a month and a half ago in one of our live chats talked about the fact that you have to take these price earnings multiples. First of all, coming out of a recession or a difficult period, you have to take them a little bit with a grain of salt. But then you also have to consider the earnings environment that you're in. And some of you may recall the nifty chart we had that showed the longer term present value discounting of earnings and how with ultra low interest rates, suddenly they became more valuable. And so some of this equation where you look at it and say, okay, where will this normalize a year from now or a year and a half from now, when hopefully we are getting to the end game or even past the end game of COVID. Um, that piece will also depend on where interest rates may seem to be going at that time, and will they stay lower for longer? So stay tuned on that one. And the next slide, PJ, you want to go through, this is a bit of a geeky slide, but it is a very important juxtaposition to what we were just looking at with price earnings ratios.
And what we're looking at on this slide is really what has contributed to S&P profits coming out of recessions. So it's looking at the past couple of crisis periods, the great financial crisis, emerging markets and oil collapsed back in the 2015, 2016, 2017 range. Late in the year there in 2016 is when with Saudi Arabia, there was a big issue, if you recall that. And so what we're looking at is what allows companies to bounce back quicker? Well, it's really this idea of operating leverage. And so just to read the quote that's on the slide from JP Morgan, the good news for profits in prior post-recession periods, S&P 500 companies managed expenses aggressively and generated profit growth even before substantial increases in top-line revenue. And so this is what the yellow portion that you're looking at across this is looking at what contributed to those S&P profits post-recession, and operating leverage is the key component. And so the question is, will companies be able to do the same coming out of this recession? Again, we've talked about the past few chats, and did the recession already end? By definition, in May. Again, by definition, it's very different from what it feels like to have double-digit unemployment, economic contraction. Still, probably in many sectors, earnings continue to decline. So again, don't think of post-recession as being everything's clear. But coming out of this, as companies try to get back to where they were, demand is going to take a lot longer to come back, just given what's going on in the economy in many sectors. And so for companies to get their profit back quicker, they're really going to have to go to really that expense control. One positive for many companies, it's been a improving trend for decades now, and really is accelerated even recently, is obviously lower interest rates. So borrowing costs are definitely not what they used to be. And so if you are in even decent shape and can either refinance or need to borrow money, it's not nearly as expensive as it was in the past. Again, obviously another area that's already been hit, unfortunately, is the labor force, cutting labor, trying to find productivity elsewhere through technology. Companies are going to aggressively do that. And so this slide alone does not mean that things are going great for everybody, but in terms of looking at the markets and looking at companies and thinking about, okay, I'm investing in future cash flows and future profits. How can they rebound quicker? Well, it's controlling that expense side of the equation, because that's all that companies really can control in the short term.
Yeah, there's been a number of analysts that we've been reading lately who are talking about where those profits will be 3 years from now, 5 years from now, 10 years from now. Again, discounted back to today. That's how stocks are generally valued. And saying that all the combination of the effects that PJ just talked about have accelerated during the pandemic. And so that's a reason to be more, even if we're more cautious short term, maybe a little more optimistic longer term, but that's from an investment point of view. If you actually work at one of these companies, the significant warning here, and this came up with a client we talked with yesterday, whose company, Fortune 500 company, is going through a reorganization. And she had taken some of our warnings seriously and been doing extra leadership training and communication training and worked with a career coach, and really had been sharpening her ability to be indispensable to that company. She said, holy cow, it paid off because I not only kept my job, they promoted me as opposed to potentially eliminating me. So this concept of this slide that we're looking at may be good if you're an investor longer term, but if you're working in one of those companies, it is absolutely vital you make yourself indispensable. You know, we've been talking about it more from the general super trend, you know, the effects of globalization, technology accelerators, automation, that companies will be able to have greater sales with fewer people in the future. But it comes home to roost in the middle of an economic crisis like we're in right now. So then we get to one of the great hot potatoes of our time, and this is where are we going to be with the November elections? And so, as we talked about in our written chat a week ago, the November elections are becoming more into focus as a potential threat on the investing side. Now, again, we have a number of people who are listening who are on both sides. We have many clients that are right in the middle. And so we understand that there may be other reasons why you're thinking about these as either positive or negative. But from a purely economic point of view, as we pointed out in last week's written chat, the D1, D2, D3, meaning we get a Democrat in the White House, we get a Democrat Senate, that the Senate currently Republican goes Democrat, and that the House of Representatives remains Democrat. That sweep increases the potential for corporate tax reform of the past to be rolled back in 2021. As we mentioned in our chat, we have feedback from some high-level Democrats that, well, we wouldn't do that if we were still in a difficult economic time, but we don't know for sure what's going to happen. I mean, there's a lot of rhetoric, and then there's a lot of what actually happens. And so what you see from these slides is the potential of the Democrats controlling the White House has gone up significantly. And by the way, this is the predicted service that you can actually go to predictit.org, and you can actually make, I will call them bets as opposed to investments. They're not investments. And you can actually bet on an outcome. And so and they do that for everything. It's not just politics. And so right now you can see 65% chance of the Democrats having the White House. As we mentioned in our written chat, at this stage of the game, it's a little too early to get terribly excited about this one way or the other. But if we roll into October and we see these numbers being this high, and then on the right, the one on the right is really the key also. It's not just the one on the left. If the Senate also goes Democrat, which you can see right here, that has gone to above a 60% odds. If we roll into October and these numbers are still as high, Wall Street will begin to take big time notice, and the volatility in stocks could become extra special. So again, this is one of those things that often happens pre-election. It is not necessarily predictive. In fact, many times it's not predictive of what is really going to happen post-recession. But this gets back to sometimes there's perception of reality and reality. And perception can be as negative on stock moves short term as the reality itself. So again, something to keep an eye on. So a general question for PJ and JT. So how should you think about this if you're a more conservative portfolio to begin with, and maybe most of your investments are more core and you really don't have much in the explore or the speculative camp? How should you sort out all this data as a more conservative investor?
Well, that is the fundamental question, Dennis. I think writ large, it's probably not a time to be taking a lot of courage. I think that this is a time to be a little bit more wary and circumspect and kind of bide our time as we move through the summer months, which are often a bit of a doldrums. As you just alluded to, the markets tend to react to the political cycle in the August-October timeframe. So multiple reasons that for those more conservative clients, I think, again, staying with our current posturing, we're not running away. But if anything, we're taking this as another opportunity where we've had a strong recovery. If we would have wished to have been more conservative earlier, it's not a bad time to make such a move. Again, for the more growth or aggressive clients, the long-term adage of time in the market being more useful than timing the market. Not clear that you need to be taking dramatic steps, but maybe selective steps if there are particular areas of opportunity that you want to pursue in, it's higher risk, but areas that have been beaten down or out of favor for a consistent period. PJ, how would you like to add to that?
No, I think I'd agree. And, when you're looking at that explorer side of your portfolio, some of the opportunities that no longer exist with the bounce back currently, but continuing to look if we get any type of second sell-off, there'll be certain sectors that are going to get hit harder. And there's some sectors that haven't bounced back. Energy isn't anywhere near fully back. Financials actually the last couple of weeks have continued to struggle. That's coming from both expectations of low interest rates combined with what the Fed came out and did, and after some stress testing, that there are definitely a couple of banks that are not going to be allowed to increase their dividend or do any share buybacks until they pass the Fed's test. So.
Okay, so that covers a little bit of, I guess what you're saying is if you're on the explore side, more growth oriented, more aggressive growth oriented, maybe it's also a time to bide your time and watch for opportunities.
I think so at this point. Just given where the market's trading, given what we just talked about, the next 2 to 4 weeks is going to be very telling with first, where does the crisis go on the COVID-19 side? But then that'll be quickly followed by what's the policy response from both the Fed and Congress as a result of that? And does it create the same type of hope? I'll use the word hope that all the action taken, the swift action taken back in March, does it create the same effect? Again, it's not going to push the market higher to anywhere the same magnitude, but will it be able to offset the COVID side, the healthcare side, which it took a while to get there back in March with the decline, but eventually the hope took hold, and we've seen the nice rally from here. The question is, will that be able to happen again, or will we be given, or will investors be given in certain areas another opportunity to buy at a much lower level for certain sectors?
Yeah, I think you've got this tug of war between the kind of second order effects of the virus versus second order effects of the government intervention. And obviously we'd be delighted if there is a robust recovery and bounce back. This is truly an unprecedented circumstance, and so we could have an unprecedented positive outcome as well. But I think the lesson of history would be that when you have a deep recession, you see a big drop in markets, you often see a strong bounce back to be followed by some sort of retrenchment. So again, we're not predicting it, but we're wanting to be cognizant of that history and positioned accordingly to be biased a little bit more conservative for the near term.
Okay. And so one of the questions to end on in the last couple of weeks, a frequently asked question by some clients is when you look at what their largest holdings are, they tend to be technology in our portfolios. And when you look under the hood further, a company like Microsoft is the largest holding that we have, and it's up 30% year to date. And so some people's reaction is, gee, we need more of that. Some people's reaction is, gee, should we be selling that and moving to the areas of more opportunity? What say you all?
It is a very timely question. You've had such a sharp dichotomy between the performance of those top 5 companies in the tech sector versus almost all the rest of the market in some regards. We've talked in the past about looking long term. Technology is at an unprecedented share of the overall market. those 5 companies are at an unprecedented share of the overall market. That is not a reason to hate them or run away or expect them to fall off, but it does line up with that adage of no tree grows to the sky. So while there's a lot to like about those companies, they're huge cash flow generation, great balance sheets. Obviously, the shutdowns tend to support their business models. Longer term, it stands to reason to us that there may be relative underperformance, meaning that other areas of the economy begin to catch up with the performance of the tech areas, and they may lag more. So we're not really inclined to chase momentum. We're not doing dramatic pruning, but to the extent we're already a bit overweight to the tech sector, a little bit more of a growth bias within our stock positioning, our bias is to actually prune back gradually and harvest some of those tremendous gains that we've seen over recent years.
Yeah, I think the key to what JT just described, obviously, is diversification, with the caveat that we do not view Apple or Microsoft in the same vein as somebody might view Tesla, which has rallied very strongly the last couple of weeks, especially. The balance sheets of Microsoft and Apple specifically are very strong, so they continue to be great companies. But something that we've looked at is, even though Microsoft was a great company back in 2000, even if you were an investor then, even though their balance sheet was strong and they did fine, obviously as they continue to grow, it took a while for the stock price to get back to where it was with the crash. And so thinking about it from that perspective, what JT said on the relative performance side, looking at the front windshield, while great companies, that doesn't equate best stock returns necessarily, because it's all about the starting point. So again, definitely think that the area, the technology sector is well positioned going forward, and will continue to be a part of our portfolios, but we don't need to overemphasize it at I'd say going forward from this point.
Yeah, perhaps one of the lessons of the past, from the late 90s to other periods of market volatility, is we've seen folks kind of plant their flag, fall in love with a particular stock or a particular sector, and not want to pay the taxes to be able to diversify. And this feels like one of those times again where you got to disconnect from that emotion, and you've just got to be very objective and figure out what the right move is. It's funny, we have a client who's a former CPA who the other day said, I don't want to let the tax tail wag the economic dog. And she then proceeded to be worried about how much tax she would pay from diversification. So it is a natural tendency. And again, we can work through that from a financial planning viewpoint, from a capital gains budgeting viewpoint. We have things that can mitigate the gains. So, we have a variety of things that we can try to soften the impact. But again, this is one of those times where I think economics has to be front and center to the thought process.
And if I may, Dennis, again, the voting machine, weighing machine adage, the momentum's been great in that technology sector. And that, the valuation doesn't tell you a lot about timing. But when you look at something like Microsoft with a PE ratio well into the 30s right now, that tends to be predictive of intermediate to longer term returns. So at some point you need to put that into the mix and begin to react in gradual steps to reduce what has been a phenomenal performer in one of the larger shares of our portfolio. And I just use that as an illustration.
Yep, good. So for one of our other very frequently asked questions around international companies, and those questions have expanded to a very long list of, should I do more? Should I do less? What's the role going forward? What does it mean that some of the international countries are coming out of COVID better than the US? Should that influence my thinking? Well, we have so many questions there. We are going to tackle them in an all international chat a week from now. And so we will go explore all those different issues on international stocks. This afternoon, I want to remind everyone that We have another special edition of Interesting People and Interesting Times. And so this is one of our What's Next series. And so it's easy to get caught in all the news cycle that everything's pandemic and that there's nothing coming beyond pandemic. But interestingly enough, the world is still churning ahead, even though it's not making the news. And so one of the massively huge places has been the technology accelerator area, and a subset of that is the Internet of Things. So we have a special guest from Intel. She is going to walk us through some of the basics of Internet of Things, give some examples of companies that they're working with and what they're trying to do around the Internet of Things, and how it's going to be one of the rock your world trends in the next 5-10 years and beyond. So we encourage everyone 4 o'clock Eastern time to tune into that. As always, these sessions are recorded, so you can pick them up later, or we have one client who sends it to his grandchildren periodically. So they may be more interested in the Internet of Things than this discussion, but hopefully it provides a little economic education as well. And we really appreciate all the cards and letters and information that's being sent by clients. Keep those frequently asked questions, keep those things that you're thinking about coming our way, because that helps us as we develop these programs. Thank you to PJ and JT for leaning in on some tough subjects today. PJ, you had a comment?
Yeah, we just had a question come through. I wanted to answer really quickly about your referencing discussing international next week. That is going to be via the written chat, is where we'll be discussing international. The next live chat like this will be in 2 weeks.
Yes, thank you. And maybe if, again, there's so many questions in that area, maybe the live chat 2 weeks from now will be a continuing follow-up of the frequently asked questions from the written chat. So we will also see what the news cycle looks like, because as both PJ and JT have pointed out, things coming up in the next several weeks, there's going to be a lot of interesting news coming out that we may want to report on as well. All right, so thank you all for tuning in today, and I hope that you have a wonderful weekend.